welcome to the UTI Swatantra series powered by ET Now. I'm so glad you joined us. We're not in the studio obviously this week, we're in Pune. And we have a wonderful audience of people from Pune who've come out on a Saturday morning to join us here and to understand investments more clearly. Now, I'm very glad about the fact that we have three wonderful guests with us. I'm going to quickly do a round of introductions. On the very left is Bharath Phatak. He's a certified financial planner. We have Amit Bivalkar. He's the director of Sapient Wealth Advisors and Brokers. And of course, Debashish Mohanty, President and Country Head Retail at UTI AMC. Gentlemen, thank you so much for joining us on the show. I want to first start by one round of questions to each of our guests. Question to you is very simple. I walk into your office today with 100 rupees saying, here is my money. I'm a long-term investor, so I'm investing for the next 15 or 20 years. Split up this 100 rupees across various asset classes and tell me which way to go. I'm going to start with you.
If you come to me with 100 rupees today, I'll not proceed without dividing this up into short-term, medium-term and long-term. Long-term money needs to be invested in appreciating assets, and the reason is money will lose its value at a steady rate over a period of time.
Yes.
And the purchasing power is going to go away unless I put some strategy in place. That strategy which makes sure that my investments appreciate at more than the rate of interest, at more than the rate of inflation. So I will have to design a strategy with which I am comfortable, which I will not panic and get out at the wrong time. And then if this country is going to progress, appreciating assets will do well over a 10-15 year period. They will include real estate, they will include equities, they will include some other commodities. If this foundation is created, then I think today equities looks a very promising asset class. But these things will keep on evolving, keep on changing. Unless I create my own strategy for inflation, I think investments is going to be a challenge going forward.
Do you agree, Amit? Do you have something else to add to that?
A couple of points to add on what Mr. Phatak said is that when you actually go and make an investment decision, you should also be aware that what is the amount of money I am willing to lose. That is very critical. So I should also know what is my risk profile. Also, what you need to take in as risk. For me, risk is nothing but losing an opportunity to earn money. Second thing is people tend to put money and have faith in banks, which is true. But end of the day, the bank manager also gives out that money to somebody as loan. Maybe it's an industrialist, maybe it's a small enterprise, maybe it's a housing loan, car loan. And your all performance of that money is dependent on whether that person is going to repay the bank or not. So what I feel is there are many things which look very plain and simple from the product, but actually you need to dwell upon and study the product before actually investing in it.
Before I ask Debashish to give us our answer, so we understand the profile of our audience here, I want to do a raise of hands for anybody who has an investment right now, who's made an investment. Just raise your hands. Okay. Anybody who has an investment in equity, whether that's direct or through a mutual fund. Okay. Anyone who has an investment in equity that you've held for over 5 years. I'm assuming you all are very happy investors right now. I want to do a round of applause for all of the people who just raised their hands, who've been investing in equity for the last 5 years. So all is not lost. There are investors who believe that you can hold equity for more than 5 years.
Pune's scenario is much better. I was just adding what Bharath Bhai and Amit have just told. See, what is important is who is asking that questions. 1 lakh rupees to invest, whether he is an auto driver or is a pilot. What is his profession, how much money he has at his disposal. So where he stands today, who is he, where is his goal, how long he need to travel, then the vehicle will be decided. Whether he go by walking, by cycle or by plane. So after deciding that, then we'll know that further risk profiling and asset balancing and mixing. But if it's a long run, I agree with both of them. Blindfold equity is the asset for long term, and he should stay invested long term and he will gain out of these things. So that risk perception that equity is risky is because people only remember the short term risk losses and not remember the gains that people have made and the institutions have made, and money is actually made in the market because that is directly related to the profits made by the company and not by the interest income on by the banks and all these things.
I'm going to stop our conversation because we have a lot of questions in the audience. The gentleman in the green shirt has a question. We'll start with you.
My question is, what are the parameters when you approach these investment firms?
Are you asking us about choosing a mutual fund?
No, the brokers or the investment
The
firms.
advisors. You're asking about choosing an advisor. Amit, do you want to take this question? How do I choose a good advisor? How do I decide if this person is a good advisor?
First of all, I'm glad that you have thought of choosing an advisor. So generally people don't think of choosing an advisor. So for investing also, when you are probably thinking of investments, you should go to an advisor to ask him that A, should I invest? B, how should I invest? C, where should I invest? And D, what is the mode that I should take to make investments? How we do at our end is that clearly we invest our money where we tell our clients to put their money. So I am in the same risk as you are. Second thing is that do you want a guy with knowledge or do you want a guy who can be trusted along with the knowledge? So the trust factor is very, very important. Third is, will you go and probably put money in some fly-by-night operator company, or will you have to trust a guy or a company who is there for enough period of time? So you need to look at the continuity aspect also. Fourth is you have to look at whether there are processes within the company. So you need to go to a guy who understands your risk profile, who will probably prescribe you good products. Third important thing which is catching up also is that many people have also been educated on what are the expenses which are there in every product. So I think you have a right to ask the advisor as to how much expense will be there if I buy into this product. Typically in case of insurances, we don't ask such questions, but when it comes to broking, when it comes to mutual funds, when it comes to others, we actually tend to ask these questions. So we move from 20 basis points to 10 basis points in a brokerage firm. कि ये मेरे को 20 पैसे में डिलीवरी दे रहे तुम 10 दे रहे हो तो आई कैन मूव माय अकाउंट बट फॉर दैट 10 basis points you might lose a trusted advisor.
Let's take another question. From the front here, is there a mic?
What are the charges involved in the SIP? Because every month we will be investing. So if we see there will be like maintenance charges every month. What are the various charges involved in SIP, entry load, exit load, how flexible it is? So we want to understand the basics of SIP.
See, a systematic investment plan is just a methodology, it's just a way of investing, the frequency of investing. It perfectly matches for the salary class because they earn monthly, so they can give monthly. And for an individual, he is paying a monthly fee for the children's education, for his driver, for his rental, for his laundry wala, for his milk wala, but nothing is paid for himself. So you have to be little selfish to keep for yourself, because the time will come when you will not earn yourself, but your expenditures will go on increasing with inflation and all. So keeping that in mind, if every month you give a paycheck to everyone for one give to yourself, and that will be invested in an SIP. Hence SIP does not have a special expenditure other than the fund's inherent allowed TER, total expenditure that is allowed by the SEBI, the regulator. So if it is an equity fund, it will range between say from 1.75 to 2.25. That small portions that is charged annually to the scheme, that is the expenditure ratio whether you are buying lump sum or SIP. Just because it is SIP, additional maintenance ratio nil. There is no extra expenditure just because it is SIP. For first time mandate launching, the bank from where you are doing these things, some of the bank may charge for registering that mandate, and then some of the manufacturers are taking up that expenditure. Some of the banks are not leaving that expenditure. And now that SIP through online is also possible, and so that expenditure you are thinking of like in house maintenance, SIP maintenance, no special maintenance for SIP other than that scheme expenditure ratio, which is a regulated one.
The lady in the front has a question. Can we pass her the mic? I'm always partial to women investors.
How do you review your mutual fund performance?
Okay, I'm going to add to her question. It's an excellent question. How do you review your mutual fund performance, and how often do you review your mutual fund performance?
I think performance is something which is very relative. Whatever gets printed in newspapers is for a particular period. It might not be the exact investment dates what you have invested. So if it is 1st April to 31st March, you are not invested on 1st April. You might invest on 30th June. So your performance is relation to your investments. So don't get confused between what the fund is performing and what you are performing. So investment performance and investor performance are two different things. That is point number one. Second is that what is good according to me? It's again relative. So I might be on the top of the table in terms of performance as a fund house for last 6 months. But that doesn't guarantee I will be at the top in the next 6 months. So what is critical is that am I going to get a performance which is better than the average? What am I trying to do? My expectation level, suppose is 12%, 13%, and if some funds are delivering 15%, then am I happy? So that should be my criteria. Third is how often. I think so you need to spend at least 1 hour in a quarter to review your investments. If there is a change, what happens typically with investors who are in mutual funds is that they say that the advisor is not churning the portfolio. In fact, churning is bad. If you have a good average return performance by a fund, in the long term, all funds typically give you a similar return. So if you look at 10, 15, 20-year performances, all mutual funds will be in the range of 12 to 15% on a compounding basis. So 1% here and there will be the difference, but you cannot catch the top performance every year. So it's like after you get married, you come across somebody, right? So you can't really have the best performance in all years at all given points of time.
The gentleman in the front.
If you see the average age of home buyers, it is reducing. Now, can you see the same thing happening even for investors? The age of investors, is it reducing?
The ideal thing is the first paycheck when they get, they should invest in the same day. Rather than donating something to the temple, they should first investing from their retirement from the same day. But our attempt, this Swatantra attempt or the investor education attempt to bring down that age. It is not happened that way, but 18, 19, whenever their internship money they start get, that also should be invested the day one.
See, 23 was the age which was any which case the investor age because your PF starts cutting from that day. Right? So you were an investor right from 23, only the product was different. So now we are trying to make those people aware of products which are not the traditional ones and where you can probably invest your money.
Products which are not compulsory. Okay, I want to take questions from the back of the room right now. There are some hands going up.
Where do you see the Sensex in 2019 and what will be the average mutual fund returns looking at the stability of India?
I don't think I can predict the Sensex. Actually, we should get out of this game of predicting the market and predicting the Sensex. But what we have to look and look at the long-term past results. If I look at the results from 1994 to 2014, why 1994? Because 1991 the liberalization process started, the markets opened up, SEBI came into the picture, online trading started. So the period earlier to that was a different period, but 94 to 2014, if we look at the 20-year period, in thumb rule numbers, you have seen the Sensex go up from 4,000 to 28,000. So you have seen a 7 times growth over a 20-year period. If you calculate the compounded annual growth rate, the number will come somewhere close to 17%. And this 17% broadly corresponds to the return on equity which the Sensex companies have created in this period. This is an asset class which in the last 20 years has given a return equal to its ROE, which is 16-17%, and there is no reason why this kind of return over the next 10 years will not be there.
The gentleman over here on the pink shirt.
So my question is, as an investor, I keep tracking my investments on a day-to-day basis. Thanks to mutual funds, they are not releasing NAVs on an hourly basis. I monitor it on a daily basis. So how to avoid it taking reaction to market, that the market is high or low, should I buy or sell? How to just stop myself from doing that?
Who
You
wants to take
consider you have planted a sapling and every day you will take out and see how far the roots have gone.
That happens. That happens.
You have to wait for the tree to go to a deep direction.
I'll try to tell you a story. I've got a Parsi friend of mine. Anybody who is Parsi here? Sorry, I've got a Parsi friend of mine, and he had told me that whenever their forefathers had bought shares of Tomco, ACC, Telco in those times, those all came with the physical certificates, the big certificates, the FAFDA certificates. From that day till today, they have not dematted it, and because of that, they don't know what is the value of that portfolio. Today, because it became into compulsory demat, and then his father told, let us demat this, and that value runs in crores. So if you try looking at that on an hourly basis, your height is not growing when you are young, if you try to measure it every day. But probably if you look at it from a quarterly basis, a 6 monthly review, a 1 year review, then probably you might see that appreciation in large numbers also. Otherwise, you will not appreciate that 0.25% gain over the last 1 week. So what is important is fill it, shut it, forget it, and let it continue for the goal period what you have actually chosen. And the simplest thing of not looking at it is don't log into your computer.
Good. Okay, there are a lot of questions. We'll take a question from the side. Yes.
Debt fund versus FDs. What is the benefits of going into a debt fund? And secondly, my other question is like the first question you put up about 100 rupees. How do you split it up, right? When you're planning an investment. Long term, it's very clear. Okay, you go for a real estate or something like equity, and 15-20 years you don't locked in. You're not looking at it at all. What about the within 1 year or the 3 to 5 years? Say like 4 years from now, I want to build a say X amount of money, and using that money, I want to start a business. So, what is the kind of investment vehicle that I'm looking at?
Do you want to take the first question?
Yeah. The question was 3 to 5 years horizon, where we want to put your money. If I calculate that as the essence. If 3 to 5 years, you choose a balance fund, where equity is also part of the portfolio and bonds or debt is also part of the portfolio, and fund manager will do that balancing. There is a pre-announced 60-40 ratio, 50-50 ratio, 65-35. So part of your money is going towards the real sector of the economy where the corporates are earning profit, and another is going towards the debt. And as of now, because 3 years is a very short, not a very short, but still a short. So balance is the suggested. If you are crossing 5, and equity you should do, and the proportion of equity should go up 80 plus, maybe 100% equity. You should look forward for that.
And my other question was the debt
FD versus debt.
Yeah.
Yes. See, when you look at fixed deposits versus debt mutual funds, now the long-term capital gain on a debt mutual fund has been raised to 3 years instead of 1 year in the last budget. So if you look at a 3 year, any interest of fixed deposit is taxed at your marginal tax rate, whatever tax bracket you are in. In a mutual fund, if you go for a 3 year plus investment in a debt mutual fund, clearly you have a long-term indexation advantage to that. So your taxation actually comes to very minimal amount. So if you have a 7% inflation over 3 years, then you actually get that as a deduction in your capital gain. So if you have earned 9% and you have a 7% indexation benefit, then you pay tax only on the balance 2%. So the post-tax return in a debt fund over a 3 year period is always better than a fixed deposit of a bank. So that tax arbitrage and advantage on a 3 year period is definitely there.
Let's take a few questions from the back of the room. There's somebody who already has a mic. Stand.
On a mutual fund side, what do you suggest? Like if I have some SIP to do, let's say 5 months in a month, so I should invest in multiple mutual funds, or I should choose that some mid cap and small cap fund. One is in that blue chip and just staying on 3-4 mutual fund, or I should invest in 8-10 mutual funds.
We get questions from investors who have 30, 35 mutual funds in their portfolio, which is again a completely redundant, complete waste of time and energy. Is it enough to have 4, 5? What's the gap?
Okay, I'll give you an example from the Hindu tradition. If you look at our own lunch or our own dinner, what we are served at home, you've got rice, you've got chapati, you've got a sabji, and you've got a dal and probably a salad. That's a balanced diet. So if you have 4, 5 mutual funds, that's correct. If you have, there was one WhatsApp which was running around where there is a thali in Surat which is 130 different varieties of food. You can't eat all that. At all points of time, over-analysis leads to paralysis. So if you have 30, 35, 40 mutual funds with you, you are not actually moving ahead in life, but you have the clumsiness of handling so much paperwork. Plus, you will have all passwords, all websites which will have their own transaction pins. All that is a headache. So for us, clearly what you need to have is you need to have a mix of large, mid, small cap and a flexi cap portfolio, which probably can be done in a matter of 4 to 6 funds, not more than that. So I think if you have 6 funds and which have categories built upon as decided by your advisor, I think you will be happier than that.
Let's take another question. Okay, we haven't taken any questions from that area.
Somebody was not asked so far.
Yeah.
My question is on how shall we diversify our overall investments? Like what portion shall we devote to fixed deposits and equities and stocks as well as golds? Like as I've read on internet and through my recent studies, that you should have some portion, like while before starting you should have like more amount towards fixed deposit and lesser amounts towards this fluctuating returns, and as you go on, as you gain more experience, you can decrease your fixed like returns investment and increase on this. So how shall we divide our overall investment in these different parts?
Amit, you want to take it?
More importantly, the thumb rule is that 100 minus your age is what you should be invested in equities. So if you are 23, you should be 77% in equities. Second thing is that don't get overloaded with one type of asset class. Typically, real estate forms 50 to 60% of your overall portfolio because sheer volume and the size of the portfolio. Like if I buy a 50 lakh rupee house, my overall portfolio might be 70 lakhs and real estate forms a big chunk out of that. So try to get into equities if you have a view of 5 years more, and you should choose your instrument according to your maturity value goal. So if I want something in 3 years, I should go in debt. If I want something above 5 years, I should go in equity. But never say that I have a 20-year goal and still I am into fixed deposits. Because if you look at a milk, from 30 rupees it has gone to 40 rupees in 2 years, which is a 33% inflation. Your bank deposit has given you only 8 rupees. Your milk has gone up by 33 rupees. Equity has the power to give you that kind of return, but a debt will be capped at 8-9% at all given points of time.
And having said that, your emergency fund you should maintain in a liquid fund, which you can take any time, and maybe 6 months your income, 6 into your monthly income, that type of amount you should keep in a liquid. Whenever you want, you can use. Then your short-term goal-oriented, long-term goal-oriented, retirement goal-oriented, children's education goal-oriented, and everywhere equity can go.
Unfortunately, we've completely run out of time, ladies and gentlemen. Thank you so much for joining us on this wonderful afternoon in Pune. On the panel, all of you have been a great help. Thank you again for coming in. And of course, if you're watching at home, remember you can always find a copy of this show on our website indiainvestkaro.com, and you can tweet in a question if you'd like to, #InvestKaro. It will be our pleasure to hear from you. Thanks for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.